Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to preview Jobs Week and talk about monetary policy, mortgage rates, and some confusing housing headlines. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. How was your weekend?
It was fantastic. I went to a dance recital for my 2.5-year-old granddaughter, and that is the most precious thing in the whole world. Of course, they don't actually do any dance, but I loved it. It was amazing.
Oh, good. Of course, now we're doing things a little bit different now. We're going to record a podcast on Monday just because if anything happens over the weekend. This weekend was somewhat mild compared to the other ones, but clearly what we could see is the trade war is not going as planned, I would say, in terms of getting deals. China kind of, has been holding some of the stuff that they sent to us as part of the trade deal. So they're negotiating. Japan hasn't signed a deal yet. So a lot of that over the weekend. Of course, the Ukrainian airstrike to Russia, oil prices are up a little bit. But this way, we thought we could handle everything that happens on a Monday and bring this out on Tuesday, just because things can get hectic. And of course, last night, Bill Pulte went on Twitter again and demanded that Jerome Powell actually cut rates.
Yeah, that's part of their ongoing pressure on Powell, right? But I don't think it's going to work. I mean, Powell has said like he's pretty resolute on that. So, but we will get something this week that could change that. It is Jobs Week.
It is Jobs Week. And of course, for all of you who haven't listened to the podcast before, we always believe here that paper, rock, scissors, the labor market is more important for rates than inflation. And speaking of which, Pulte last night said that the Fed cut 1% before the election, and then the growth rate of inflation was higher during that period of time. Well, technically that's true, but that's not what the Fed actually is looking at. The growth rate of inflation, you remember when the Fed tracks this, they look at 3, 6, 12-month core PCE. Headline inflation was 2.1%. If they really just moved off the growth rate of inflation and believed that neutral policy was, much lower, they would have cut rates already. But that's not kind of how they operate this time. But as Jerome Powell said, they were a little bit late in cutting in 2024 because, the labor market was getting softer and they reacted to it a little bit late. And that's why they did a 50 basis point cut. But now, again, Jobs Week are really important for those multiple data line sets. Job openings data is something the Fed really tracks. The quits and hires in that are very key. ADP report is the least important, but that can move the markets if it's really bad or good. Jobless claims happens every single Thursday. That's always key. And jobless claims has been ticking up from the lows recently. And then Jobs Friday, which 3 months ago, on Jobs Friday, the 10-year yield was collapsing. And I remember tweeting it out that, guys, if it wasn't for these tariffs and people think it's taking us to recession, bond yields won't be this low, right? It's the only reason is people are going into recession mode. So the labor market, if it's authentically breaking, means rates can go lower for a longer period of time. And that's why we always keep an eye on Jobs Week in itself. And the reports haven't been bad. I mean, that's just my interpretation that the labor market means more. And the Federal Reserve has made comments about this for some time now, and trying to get people on board on this has been a little bit more difficult than I thought it would be. But this is why Jobs Week is very important.
What's the labor trigger from your perspective? What's the number that's going to make it where we'll see lower rates? Is it
So here's an interesting fact. By the way, the Federal Reserve's librarian just followed me on Twitter over the weekend. So that's my
nice?
highlight, So I'm very happy about that because the St. Louis Fed came out with a paper on their jobless claims, and they look at the history of economic cycles and they say, well, jobless claims gets to 400,000. The labor market is pretty weak. No, there's a certain percentage where jobless claims rise from a low base. And to me, is if the 4-week moving average is heading toward 323,000, that means authentically the labor market is breaking. Because once jobless claims break, there is no equivocation. The recession is here. This thing breaks and it breaks hard. We haven't had any of the labor triggers yet, whether jobless claims or residential construction workers, or I mean, just construction workers in general. A lot of people use other data lines, but those two things have worked every time because it's usually at that point where growth. GDP came out today, was the Atlanta Fed's estimate is like 4.6%, right? So we had a very crazy first quarter. We have very crazy second quarters. The trade data is really impacting both GDP's numbers. So you take it with a grain of salt. But again, the US is a consumption based economy, and consumption per the GDP is what the Fed tracks. And they said, hey, it's been good, stable for the last few years. That's why they're holding back until when the labor market breaks, then they have all the cover in the world. And they could say, oh my God, hey, listen, it's we have to do this now because labor over inflation, dual mandate. But right now it's just softening, right? Softening, not breaking. It was getting softer, but job growth stabilized, wage growth stabilized. So these are things we want to keep an eye on because we've done a lot of things to the economy this year, right? We cut spending. We fired federal workers. If there's less money to the states, they can't hire as much government workers. Then there's a trade war, tap dance. What's going to happen? But now, if they do get some deals off, I think a lot of people are less worried about a recession. And even the Federal Reserve has said, well, if you get trade deals, we could be more dovish again. But again, if the labor market getting weaker is a valid premise for yields to go lower and stay lower where Fed policy is today. And this is why I can't forecast below 5.75 rates. The only way we even get to low sixes is through an economic scare.
It's so crazy. We have thrown so much at the economy. This economy is so strong. And the honey badger labor market, you're going to have to think of a new name for the labor market if it starts weakening, because it has been a honey badger labor market for
Yeah, I
years.
mean, it's part of, and we wrote this in the COVID-19 recovery per the labor side of the equation, because baby boomers are leaving, right? Nobody's Dorian Gray. Everyone ages and then they leave the workforce and then they die. That's economics, right? If you cannot accept death, then you live in a fantasy land. So as the baby boomers leave, we have really good replacement workers. I always thought that the best thing the US has, its demographics are much different than other countries. We have good replacement workers where China, Japan, and Europe doesn't have it. We've been talking about this for well over 10 years. I mean, before you even knew me, Sarah, this was my pounding the fist. Because they're replacement workers and consumers, we have an edge where you can grow demand and then replace older workers. And other countries really don't have that. So the labor force growth, if it picks up more, the unemployment rate has a better chance of going up higher. But if the labor force growth contracts, then the unemployment rate has a better chance of staying low because there's not that many people looking. So this is something in this century where older countries just don't have enough people coming in. So their unemployment rate can be lower than what they usually are compared to a young country that has a growing workforce and so many people looking. You got to create jobs for everyone. We're more on the mature stage, but we do have no labor, no economy has a Dorian Gray labor market. If you don't know who Dorian Gray is, all of you should be ashamed of yourself. People just age and die, and that was one of the big variables we've been talking. I remember May in 2021 where we had a missed jobs report, and everyone's like, we're paying people to sit at home. And I'm like, no, we're not. Job openings are going to get to 10 million, and everyone's going to be complaining about nobody wants to work. And guess what happened? Job openings got to 10 million. Job growth picked up. We got all the jobs back in 2022. Labor force is still, because people work, and people just, you got to work to make a living, and that's what we do in America.
And we have those Gen Zers. That's our saving grace.
Well, I mean, honestly, without the millennials and Gen Z, man, I mean, first of all, just to give you guys a scale, millennials and Gen Z put together are bigger than the total population of Japan, right? And 40% of Japan's population will be dead by the end of the century. And what other stat that we have for Japan, Sarah Wheeler?
It's the one that made people gasp actually at a live event.
Japan sells more adult diapers than baby diapers, right? They're
Right.
old. They're a very old country, and for the first time, Japan is actually welcoming in immigration. Boy, that's That's how bad it is over there. For them to actually want immigration, because robots can't do all the jobs, right? And people age, and if you don't have a growing or a healthy immigration, or having babies, they don't really do that. So they need immigration to kick in. So we're just a unique, dynamic economy because we are the baddest economy in the history of planet Earth. So
I mean, a lot of those Gen Zers, though, I mean, those are immigrants or babies of immigrants or, grandchildren of immigrants. I mean, that's been one of our strengths.
if you look at the history of immigration in the U.S. starting from 1820, basically majority of our labor force growth is all through immigration, right? Because we have people come here, they get married, they have kids, and their kids get married and have kids, and that transcends it over time. So that's our benefit. Really from 1820 on, if you look at the immigration data, and that's majority of our labor force growth going out in the future. So that's always been one of our strengths, where other economies are just not going to be able to catch up. China's not going to catch up. Their one baby policy has it finally caught up to them. Japan's no way, right, in that sense. And Europe is old as well. So we've got it. Like this is why I always laugh at people say, "Oh my God, the dollar's going to collapse. The U.S. is going to go." It's like, just go away. So we're literally just move on, man. Stop crying.
So we have there's so much to talk about on that front, but I also wanted to bring up. So we had a story last week that Redfin came out that caused a lot of people to be asking about like what's happening with the housing market. So and then they have another story today. So I wanted to ask you about it because so many people have asked you what you think about this. So last week, Redfin had a story that was picked up by lots of people, including us. The housing market, here's their headline. The U.S. housing market has nearly 500,000 more sellers than buyers, the most on record, that will likely cause home prices to fall. So that's a big number. People were really like, what's going on? So I would love for you to unpack that, Logan Mohtashami.
Okay, so I want everyone, you have my permission to take any Redfin headline with a slight grain of salt going out in the future, because there's nothing actually wrong with the data. But this morning, Redfin came out again and said, we have near $700 billion of listed homes that are unsold, the most ever in history. Sarah, if it bleeds, it leads. Redfin's got a new ownership, right? So now that's crafty. I get it, because if I'm answering questions, and I just looked at the data and they have a buyer sellers inventory gap, or, I just look at, inventory is almost back to 2019 levels. I mean, for our data, we're actually right there. So we've just had, biggest crash in home sales in 2022. This is the fourth calendar year of home sales being near all-time lows, especially adjusted to the workforce. And inventory grows, right? The whole concept, what was the whole concept of team higher rates in 2021, Sarah?
We needed more inventory so rates would cool down. I'm
So
sorry. We needed higher rates so that home sales would cool down.
So for those who do not know how blunt I am, remember what I said in 2022 on record 3 times. You remember the quote? Okay, the quote was, we need.
Oh, yes. Okay.
Yes, the team higher rates was that people don't realize when prices escalate out of control, especially due to a shortage. It's the worst thing when it's a shortage. Because there's really not really deserved. We just have too many people chasing too. Everyone was happy because more people were doing business. However, didn't realize that what was going on was going to be very detrimental to demand going out in the future. So it is always me at this moment in time, because why? Sarah Wheeler, people are here to make money, right? Home sellers are not like they're going to sit there and go, hey guys, listen, let's not get a bidding war going, because let's think of the future. Hell no. Everyone's going, I'm going to make as much money as I possibly can and go on.
Right.
That's why I always laughed about, the commission things. People are like, oh my God, if they don't have to pay commissions, home sellers could cut prices. Oh, what world do y'all live in? What amount of alcohol did you drink at that bar to come out here and say that? Like, when does that ever happen? No. So, I obviously wasn't a fan. If I'm talking about the housing market's unhealthy, late 2020 to we need higher rates in all 2021 to very unhealthy to savagely unhealthy in 2022. And then rates came out. But one of the things I remember about this cycle is that 4 to 5% mortgage rates weren't doing the damage that I thought it was. And now
Right.
that we're in 2025, imagine if rates never went above 5%.
Oh, I
We'd have a much different dynamic. So when mortgage rates went to 6%, I was like, okay, I'm finally seeing some of the things that, to try to create balance. And then rates went back down to 5%. I was like, oh, I mean, and I was quoted. I was like, no, you people don't understand. We need higher rates to put home sellers, home builders, and investors on their bleep because this can go on. So think about what has occurred. It's taken the fourth calendar year of the lowest home sales ever just to get inventory to the bottom end of the 2019 level, which was the 5-decade low. All right. So the only mechanism we had was higher rates and to do that. So I'm very happy in 2024 and 2025 because I look at it as on the economic side. I don't care how much money you need to make or they need to make or anything. I just look on the economics. So to get a balanced marketplace, you need higher inventory. Why are the home builders at 2019 home sale levels? Why is purchase application data for the new home sale market at pre and post COVID highs? Because the builders they got their heads handed to them. And then they're like, okay, we got to pay down rates. We got to pay down rates. So they are a sense buyer's market in that construct, right? Because their monthly supply has been, well over 6 months for years now. So they need to move product because they're efficient sellers. The only way I could get any equilibrium is rates to stay high enough. But Redfin is using confusing headlines to get people to read and share. And then you know how the media is, oh, Lordy, do me for it. Let's do this. And today they said all-time high. I said, well, guess what? Home prices like escalated out of control. The nested equity portions are the highest level. So naturally, inventory, even though it's not back to normal, is at the billions of dollars. Yeah, but it's a catchy phrase to get people. So I was okay with whatever headline that last report was, but with today's headlines, no. So we got shots fired, asterisk, Redfin is in the penalty box for sensationalizing headlines because I get it. They got new management. You get people in there. I think in the article they wrote like Redfin's like, you guys better list your house. Better list your house. Home prices might fall, So it's like now I'm like, okay, no. No, what's happened is what we've talked about. Higher rates, weakness in demand, 70 to 80% of sellers or buyers. Supply is a function of demand. Inventory can grow. This is why we're not part of the mortgage rate lockdown. This looks pretty normal to us. But it got confusing when people say all-time high. And then you look on X and just like Twitter, you're like, oh, dear Lord. It's like, oh, my God. And I'm thinking, and then after today's headline, I'm like, no. You get penalty box for that
So I
out
guess
there.
my question on there's this many more sellers than buyers. What is that really measuring? How do you measure how
So
many buyers
So
there are?
yeah, this is a good question. Let me give you the NAR's data on this if I wanted to try to make it comparable. So the all-time low in the NAR's inventory data was 860,000. Right now we're at 1.45 million. It's like about 590,000 more. Redfin was what, 500,000. There's more sellers and
Right.
buyers. So if we wanted to create a construct, now Redfin has their own buyer seller equilibrium demand where they think this is where buyers should be. I just look at it as higher rates, weakness in demand, inventory can grow. 70 to 80% of home sellers are buyers. 20 to 30% of those are not. That inventory can stay. If mortgage demand does not grow, okay, those homes could stay on the market for longer. That's kind of how I looked at it. But now that I've seen back-to-back headlines of all-time highs, got to be careful, right? So, and I love Daryl. I love all my people in Redfin. I was, when people were like taking Redfin's data and creating their own charts on it and totally misrepresenting it, I told them, you guys are going to get sued out of your minds if they catch you. So stop taking Redfin's data and misinterpret it. Because it's funny, a lot of the doomers just don't have the training to read home prices. So naturally, they thought home prices were falling like in the second half of every year, and they're like, "Oh, home prices are already down." Reading is a good thing. Reading is a good thing, people. The history of human civilization has always taught us. We always say that in 2,000 years ago, parchment. You get a horse, you go, guys, you get your horse, you go all the way to the ocean, you get on a boat, and you tell them the Spanish Armada is coming. By the time it's that Spanish Armada's already came. Now you have
Right.
the internet. And when you have the internet, everyone's an expert, right? So I'm just giving everyone be just a little bit careful with Redfin's headlines when they go all-time highs, because it naturally should be an all-time high. We the highest about home values ever. Inventory is up to 20. We're near 2019 inventory levels. The reason I have 2019 inventory levels as key is because I am done with the low inventory talk. Once we get NARs 1.5, we're already there on our own data lines with Altos, but 1.52, you will never hear me say the word low inventory. That's a functioning marketplace. There's enough days on markets, monthly supply. Of course, the Northeast is the only thing really holding that back. That's much lower in parts of, but any part of the U.S., any city that is at 2019, you have enough inventory for a functional buyer seller marketplace. And I wanted to see this because price growth slows. You're not going to get 3% mortgage rates anytime soon. So housing has to heal by itself through duration. But be careful. That headline today was like, it is so rare to get the Twitter trolls to even agree with me. Even they were like, what is that? To get them to even say, and that headline says, I say, new management.
So
Catchy.
what level of inventory would be, because when you say back to 2019 levels, it's not like 2019 had some like crazy amount of inventory. At what point would you feel like, oh, this is concerning inventory wise?
What is the concern part? Like
That
when
there's too much inventory, which means that like home prices would crash.
okay, so the only time post World War II that national home prices crashed was not so much inventory. The active inventory got to 4 million in 2007, right? So 2007 and 11 home prices fell. But what people forget is that a huge portion of the percentage of sales back then were distress. So when you add distress sales into the equation, and then you have underwater mortgage, see, the housing bubble was not very good because you had foreclosures and short sales and everything. And people go, I saw some terrible Instagram. By the way, the guy who sent me that Instagram video of like the banks are holding all the foreclosures back. We have had so many economic cycles post World War II. We've had so many recessions. We've had so many foreclosures. None of them were a crisis except for one period. And then I saw another Twitter account said, hey, everyone's broke, y'all. Oh my God, there's like $18 trillion of debt out there. Homeowners are broke. I was like, so I listed all the, I was thinking the best financial profiles in history of America, homeowners. Like, why is the U.S. consuming goods and services still? It's because the middle class and homeowners. And we listed every single thing in history. You want to know why the bearish American, Russians, Chinese, and Iranians have been wrong about the United States? None of y'all read. This is not a financial profile of broke. You have no idea what broke looks like. Broke is I cannot pay for my food. At the end of the day, that's what broke people do. Somebody sitting on $1 million of equity making 300,000 is not broke. It's like, well, we're selling homes to poor people. No, you have no idea what poor people are if you're saying, oh, this poor person's buying this $800,000 house in the San Fernando Valley. No, they're not poor. If you are able to buy a house with where prices and rates and taxes and insurance have, you are making money. So the whole conversation gets astray. So this is why the chart daddy, chart poppy, brain candy, whatever y'all want to call me, comes in and cleans it all up. So Redfin gets a penalty flag for sensationalizing all-time highs of homes value. Of course, there's $52 trillion of home values out there. There's like $35 to $37 trillion of nested equity. So naturally, when inventory grows, that number is going to grow. So supply and demand equilibrium, months of supply matter to me, to my work. I never saw 6 months as balance. I've always seen 4 months as balance. So if you're
Okay.
looking for distress, monthly supply would actually have to be much higher with active inventory. But I always look at that as a functioning marketplace. Like the more supply, the more choices. That's a positive for me. So it's a little bit differently. But the one time that to answer your question, we had foreclosures, bankruptcies, all these things were rising 4 years before the Great Recession happened. We're always going to see late cycle lending risk. So in that context, when you have distress sales, monthly supply increasing, that's a problem. right? That's what I would see, that there's something wrong with the credit market system. So we are just trying to get a balanced marketplace so buyers have a little bit more say, because rates aren't coming down. And you have all this selling equity here. The builders have shown you a model to get more home sales, offering concessions. If you want it, there it is. Right. So that's why I always say that efficient sellers, the builders, are up here with their home sales. Their purchase application data is at a pre-COVID high. We're all down here in the 1990s. Now, the question is are there enough buyers into the system, mortgage buyers, where you do that? So the supply and demand equilibrium works off that, but we have to get back to 2019 inventory levels to create some kind of myth. So I'm not worried about home prices nationally falling. We have people throwing up numbers, 25, 35, 40%, all for years and years and years. Go look at these YouTube people. Oh, the worst housing market, everyone's broke. Oh, y'all are clowns. Seriously. And we're sitting here in 2025, and every recession call has been wrong, and every housing bubble price crash is wrong, because you are not serious people. But I'm a serious person. Sometimes.
So when it comes to economics. No, I so appreciate that, Logan, because I mean, we see it all the time. We have to react to. I know people are. You got so many questions after some of those headlines where people are like, "Is this bad? What does this mean?"
Yeah, it is. It is interesting. Somebody came to me on Instagram and said, "Why are these people selling their homes? Why is this happening? I thought they have a low rates." No, there is no mortgage rate lockdown. I always say, we have this debate, is people keep on asking me, why are people selling? They have such a low rate. No. Total housing costs. We have sellers every single year. People have to move. They buy other homes, but why are they paying 7%? No, the total payment is what matters to them. And I was like, I sit here and I say, okay, this person makes 65,000. He's worried about somebody who makes 350,000, who's just buying a bigger house for himself. Y'all don't have to worry about him. Don't worry, because if they can't afford it, they wouldn't put their own, but they can afford it. And this is how we have near 5 million total home sales again this year. We had it in 2023 and 2024. We get 5.4 to 5.8 million total home sales. That's like roughly the range of the last decade. The peak was near 6 million. The builders are already at 2019 levels. You have demand there. It's just, for some people, it's the affordability crisis is not as bad as it is for people that have less income. And this is why home sales stopped crashing after, when was it? November 9th, 2022. The infamous date. And at that time, we have flows. Like last year we had a few months, June, the summer months, all the way up to October. June to October, we had sub 4 million, which is really rare to have, but we have it. It isn't like crashing, but we did have that. Why is that happening? Because sellers are buyers. And that's how we get 5 million. So we are missing at peak is about 1 million mortgage buyers from the peak of last decade. Because there are people, it might not be affordable to you. You might not understand why people sell their 3% mortgage to buy 7, but for them, it's their life choice and they can afford it, because you can't fudge it anymore. Qualified mortgage changed everything. Right. That's why I was worried about inventory falling for all those years. I was like, you don't have people just like flowing themselves, oh, I could buy this house, anything. So the credit markets are so different. We did that podcast, I think last year, where we tried to explain what's going on. So when we talk about the inventory data, I brought this up yesterday just to give some people clarity. The last time inventory grew, except for this year and the previous year, is in 2014. The NAR's total inventory peak. You want to take the peak to peak levels. Peak was 2.24 million. In 2014, it went to 2.35 million, right? That was the last time. Here, we're working from such low levels that you're going to get a natural increase in progression, but we need that. We need to start a year at 29. We're good. And whatever happens with the market, it's functioning. It's a function. I cannot wait to like zip it with the low inventory, because I'm not one of these people that say, well, there's 3 to 4 to 5 millions inventory short. No, I don't care. All I care about is active listings, because active listings is the functional marketplace out there. So for anybody that takes a Redfin, you have my blessing. We're going to have a yellow card. for Redfin headlines. If they're going to go all, if they're going to go all-time highs again, everything, and try to get people to catch, we know how that works. But man, I cannot believe that it was the first day of my life that people on Twitter, X, the trolling men with no real names and faces were like, yeah, that seems kind of weird. I was like, yeah.
That's a sign for sure. Logan, we are out of time. And thank you so much. Thanks for the good explanation. We will talk to you again soon, as always. And who knows, between here and there, what will happen? It's just, you never know these days.
Like, what do we say? Nothing is normal after 2020, right? We've
We're
never
still
had a
not
normal
normal.
year. Boy, I don't know what I'm going to do with myself if we have a normal year.
All right. Well, talk to you soon. Thank you so much.